Hi everyone, I'm Ken from Crypto Trading KS and the CTKS method. Today we'll go through the latest news headlines across the Wall Street Journal, Reuters, Bloomberg and the crypto market. Let's run the numbers. One thing to remember, when you're reading news sentiment, Rule 101, news reflects current sentiment. It doesn't reflect future sentiment, just what's happened. Turning first to the main markets, stocks rebound to notch the best week of 2024. Wow! And of course, this must mean that the recession fears are fading. And we can see across the past week, the Nasdaq has come up, the S&P 500 and the Dow. Where's the Russell? Oh, how rough. This particular chart was pretty cool. The S&P 500 notching that really great week. We come back to October 2023 and we can see that we just notched a pretty good week then. And then the following weeks were positive. Are we anticipating something like this to occur? We can basically see when we get really good weeks, it tends to follow through. Please let me know in the comments, do you think this will be the case? Just when you thought it was safe to go all in and more at the current price, you get something like this. The S&P is far from a key technical support level. Oh no, I was just so confident to buy and go all in, and now they've given this chart. Pesky news outlets. Jackson Hole is coming up, and Jackson Hole is where all the central bankers centralize. One thing that we're seeing, the harmonized unemployment rate in OECD countries is really starting to bottom out. Does this mean that unemployment is starting to come back up, or could it go lower? Please let me know what you think in the comments. The market is currently pricing in 3 rate cuts by the Fed for 2024. When it comes to business activity, when we look across Australia, the Eurozone, France, Germany, the UK, the US, and Japan, we can see in terms of expansion versus contraction, the US has been expanding, and it's been expanding quite strongly relative to its peers. It also looks like Japan's sticky inflation is not going away. That's why they call it sticky. And if the inflation doesn't go away, more rate increases will be on the board. And the Bank of Japan lifted its policy rate by 25 basis points on July the 31st, and that caused the Japanese curry trade to go nuts. Just joking. It was the Japanese carry trade. The unwinding of the Japanese carry trade just left stock markets globally just coming down. We've seen them rebound on the hope that the Bank of Japan won't increase interest rates, but it will. It's just a question of when, and when we look at oil, there's some key dates in here that are pretty cool. So I just wanted to share this one with you. Currently, inside the US, mortgage applications are at their lowest level since 1995. And when we look at the mortgage purchase application index, we can see it's not doing that crash hot. It's really down low. The University of Michigan Homebuyer Confidence Index has been plummeting recently, and we saw a contraction in building permits in yesterday's data releases. Traveling across to China and looking at their home prices, China home prices have just plunged more than since 2015. Ouch! And those decreases in home prices have been far prolonged when comparing January 14 to January 2015. The notoriously unreliable Atlanta Fed GDP Now estimates have actually decreased GDP just between the 14th and the 15th, down from 2.9 to 2.4. Looking at Germany's consensus GDP forecast, it's forecast to come down for the remainder of this year. And when it comes to inflation, we're noticing it everywhere. The Big Mac went from 50 cents to $8 and lost 40% of its size from 1980 to 2024. And it's not just happening with Big Macs, it's happening everywhere. If you've come across any shrinking products, please let me know in the comments. There's so many of them. When we look at market expectations for the federal funds rate, we can see Charlie is saying that it's coming down. Now, where does he get this from? The data is from the federal funds futures. So we're expecting a lot of rate cuts as we progress forwards. Please let me know in the comments, what do you make of this specific chart, and I'll go through and talk about it in the next video. Some interesting data releases from Bloomberg. The Bank of Japan owns 80% of the country's ETFs and 7% of the entire Japanese stock market. Wow, according to Morningstar and the Tokyo Stock Exchange. Moreover, the Bank of Japan holds about 55% of government Japanese bonds. Now, when we look at this particular understanding, they're basically saying that the yen is following the Mag 7 index. When I used to lecture first and second year statistics for my students, I would have to pull out different charts like this. Now, what is it saying? I would get my students to interpret these charts. Now, if you interpreted this, you would probably look just about here. However, the statistical mind looks a little bit differently, and it tries to find areas where things diverge. By the way, if you looked here, you would say, oh no, if the US dollar or dollar yen combo comes down, that's it, it's all over. What, like here, is it all over there? Or for example, could it be all over here? Oh, not really. You have to be really careful about how people interpret charts. Another really interesting chart that I found in the past 24 hours. I'm always seeking to give you the best value I can possibly give you. And look at this, the S&P 500 divergence from the Euro Stoxx 50. It is unbelievable. You've probably been hearing about the monkeypox virus or Mpox virus. The WHO has just said to governments all around the world, prepare for mega lockdowns. Oh, brother, again? And Homer Simpson, wow, having beer with a monkey is not a good idea. On all this terrible news, what is gold doing? Gold is breaking out. It's just going for it. And geopolitical risk, wars, viruses, everything like that, is really good for gold. Gold loves those things. That's why Peter Schiff is so incredibly positive as a human being. Global CTA positioning is really reflecting the 2020 crash, and we can see that it's coming down. But when it comes down, it doesn't always signify just the end of the world. It's just the nature of things. And if you're wondering what a CTA is, here you go. Here's something for you. This chart was also really good. Aggregate net retail purchases. What have they been doing? What's retail been up to? It's been buying the dip in a big way. What about corporate America and their buyback authorizations? Well, they've also been buying the dip. In other news, South Korea's National Pension Service, or NPS, which is the third largest public pension fund in the world, purchased $34 million worth of MicroStrategy shares in the second quarter of 2024. And when it comes to Bitcoin, you don't have to buy a full Bitcoin to have value. A lot of people think that crypto is like the share market, where you've got to buy one share or 100 shares or whatever number of shares. The truth is that Bitcoin is broken down into Satoshis, and you can see what a Satoshi is here. I think it's a pretty cool chart if you're new to crypto. MicroStrategy is a huge holder of Bitcoin. Now, we need to look at MicroStrategy's chart with that in mind. MicroStrategy closed out at 133.09 and was 132.65 post-trading. You can see here this blue line. That is Bitcoin's price. And there definitely is a correlation, although it's not necessarily perfect in terms of magnitude. But directionally, it's pretty damn good. What does that mean? If Bitcoin is going up, we anticipate that MicroStrategy will be coming up as well. If Bitcoin is coming down, we anticipate MicroStrategy will be coming down. Therefore, it's pretty important to look at Bitcoin. But there is actually a little bit more to this when we look at structure, and these are structural levels formed over 9,300 days worth of data analysis. We can see just above that 139 area, there was a structural resistance level. Now, these structural resistance levels play to the right. What you get with typical indicators is they play to the left. In other words, they can't forecast where things could go. And what have we noticed here? From that 139 all the way down to the structural levels below, price was caught. And it's been rebounding between structural levels all the way up, retesting that 139 level, but failing. If it fails, it's coming down to lower structural levels, lower structural support levels. It's critical to know where your structural levels are. For example, if you wanted to buy MicroStrategy, just coming in at the 130 level, the 128.50, for example, the 127.50, all of those levels are reasonably strong. And of course, the lower levels are also important to understand. Let's check out some more crypto news. And now we're looking at Bitcoin because Bitcoin literally seals the fate of the crypto market. Bitcoin ETFs see a 27% surge in institutional adoption in Q2. Cool. Inside the CTKS family, we believe in buying on red and selling on green when we're trading. And we do a very specific thing called borsogging. These were flying around crypto Twitter in the last 24 hours. We don't do these kind of things. We do the opposite of those kind of things. And in other news, Bitcoin crash at hand. This key metric hints at a potential price drop to 40,000. Metrics are not important. Structure is all important. You need to know where the safety nets are. And in other recent news headlines, remember just about 3 days ago, everybody was talking about $100,000 Bitcoin, and now they're talking about $40,000 and $30,000 Bitcoin. How things change. Is Bitcoin still at risk of further correction? CryptoQuant says, yeah, it is. But is it? It really comes down to structure and not fractals. And talking about fractals, let's have a look at one. About a fortnight ago, I put this fractal in play, and many people said, Ken, your fractal is wrong. You have to match that negative price there to that negative price there. Actually, you've got to be as statistically significant as possible. And remember, I was talking about indicators. Indicators are leftward looking, not rightward looking. Rightward looking indicators are structural levels. Leftward looking indicators are just typical statistical indicators. And these are all the moving averages, the 50, the 100, the 200, and the 150. In yesterday's video, I talk about always do your own fractals and make sure that they are as statistically significant as humanly possible. It's very, very important. Don't just fit price to current price action. This particular fractal has existed for about 2 weeks. Now, one thing that I say and one thing that I suggest, if we do get a lot of negative price action, that just creates once in a lifetime generational opportunities to buy, not to run. But unfortunately, what happens is people run away. When the price goes red, they run away. So they sell all the way down here and they buy back all the way up here. That's not the way you want to do things. You have to just think about financial markets differently. Think about it like a sale on your just most happiest thing that you can buy. Most happiest. Most beloved. For example, if you wanted to buy a phone, you want to get it when it's on discount, don't you? And you may hang around and say, oh, can you give me 10% off, 20% off, whatever. You're not going to buy that phone when it's plus 30% of what you could have bought it for. But inside financial markets, people think the inverse of this. Oh, when it's on discount, I'm going to run away. And when it's really overpriced, I'm going to come back. You see so many memes about that. If you can relate to that, please let me know in the comments. Crypto has had a lot of crypto-specific things. For example, the Mt. Gox trustee wallet balance is coming down at the current time. And the US government and Germany's government had sold Bitcoin as well. In other news, the $1.6 trillion Franklin Templeton files a crypto index ETF that will initially hold Bitcoin. Wow, how cool. If you're making your decisions just solely based on news headlines, you can drive yourself absolutely nuts. You need a way to understand that the global news is just the retail pulse. You need to look at the market impacts, which is actual reality. But then you need to go one step further and look at the institutional pulse. And many thanks to JT for your very kind comment. Thank you to everybody who watches and especially comments. It's just wonderful. You're the most amazing community on YouTube, without question. And Kate and I appreciate you so very much. In the past trading session, we saw all sectors come up, not much, a measly 0.2%. Financials did the best, and industrials did the worst. The financials had a bit of a good day, and Nvidia also did well. We saw Tesla come up quite a bit, but it was just up under 1%. Google also did some recovery, but Meta got whacked. Inside the crypto market, across the past 24 hours, we've seen Bitcoin come up 2.63%, a much greater percentage basis than Ethereum or BNB, which is quite intriguing. That basically means we're having a flight to safety at the current time. And that's not surprising by looking at the news headlines. In the past 24 hours, we've seen Bitcoin come up, Ethereum come up just a little under half of that. Solana has been hit. It's been coming down. You notice there was quite a rotation into Solana and away from Ethereum. I would imagine we're going to see the opposite occurring. Solana is still a really good, solid project. But as Ethereum comes into its own, especially because it's been hammered into the dirt, we would anticipate capital flows forming in that direction. It's just something that you would want to be aware of. At the time of this recording, the greatest gainers on the 24-hour basis were Uniswap, Aave, Helium, Rune, Ronin, Tron, DYDX, Arweave, and Optimism. The greatest losers across the past 24 hours, Aptos, Phantom, Bonk, Whiff, Celestia, Ondo, Jup, Solana, and Brett. Typically, this is as far as retail goes. It only looks at the news headlines and only looks across market impacts. That's not the best place to stop. After being inside financial markets for nearly 4 decades, you have to look at the institutional pulse. It's really important. And BFF was first yesterday. Wow, what a legend. And thank you very much, my friend, for your very kind comment. One thing to be really aware of, you do not need certainty. You need a strategy to profit from uncertainty in financial markets. Financial markets are inherently uncertain. This is not a bug, it's a feature. In yesterday's video, right at the end, I was talking about junk bonds and how they could run into a degree of consolidation here. They actually broke out and went higher, and that is what pulled the entire market with it. Keeping your eye on junk bonds is a very good thing. What's this little eye here? That's the eye where we were yesterday, and this is where we are right now. What you will find as you spend more and more time inside financial markets, the news is basically noise. There is some signal in there, but it's fundamentally noise. What we seek to do is to help you to move from fear into confidence and to profit in any market condition. This means that you will need to have flexible rules, and you'll need to have rules first before they can become flexible. The other really important thing is to look at the structure of the markets and also the intercorrelation and interdependence. We're going to just have a quick look. It's also helpful to understand that there are different tiered charts. There are the engine of financial markets globally. These charts are incredibly powerful. They can dictate just about anything. And the Tier 2 and the Tier 3 charts are equally as important because they tend to just reference what could happen with the Tier 1 charts. The Tier 1 charts tend to move more slowly than the Tier 2 and Tier 3 charts. They're all important to understand, especially the structural levels, because structure determines the price waves. When we talk about flexible rules, Rule 225 is a pretty good one. Bitcoin cannot escape the stock market's gravity. Now the key word here is escape, and the second key word is gravity. I'll show you exactly what I mean. In yesterday's video, we had a gravitational variance in the major market indices. You can see that Bitcoin was coming down, probably because of fear about Mt. Gox or the US government or any number of wide-ranging things. But the issue is that it came down, whilst the major market indices were going up. We can call that gravitational variance because typically we expect them to move together from a directional stance. Now let's have a look at what happened in the last trading session. Now what you can see, although we had that variance, they've now become realigned. So we have what you would call gravitational alignment. As the S&P 500, the Nasdaq, the Dow, the Russell went up, we saw Bitcoin start to recover. As they came down, we saw Bitcoin get hit. But as they started to turn around, we saw a rallying. Gravitation is aligning. You've got to be really careful about making just assumptions based on one day of data. Gravity is very, very important to understand. And looking across charts is a really good thing as well. I was commenting on how gold was going up and how Bitcoin typically has a bit of a delayed reaction. And you can see they're starting to align now. That inverse relationship between the DXY and Bitcoin and yields and Bitcoin tends to play out. So there are other things to keep your mind on. Looking at the S&P 500 futures from yesterday, there was a bit of gravitational variance. We saw Bitcoin come down for crypto-specific reasons, and this divergence is always on. You just have to be aware of it. This was what was happening yesterday. There was some degree of correlation with the Russell 2000, and the Russell 2000 is a really good thing to keep your eye on. And notice how they didn't put the Russell 2000 in that particular chart. It didn't fit the narrative. For the past trading session, looking at now, we have gravitational alignment. Bitcoin is coming back to reflect what the major market indices are doing. So this is something to bear in mind. When we say the Bitcoin cannot escape the stock market's gravity, this is gravity in real conditions. Another really good rule is Rule 45. No alt can escape Bitcoin's gravity. Now, what exactly does this mean? Let's have a look. In yesterday's video, Bitcoin sold down really significantly, as depicted by that really fat arrow. And we saw it was just there, just starting to curve around. What happened next? It pretty much went up. And we've had a bit of a reversion. Why did it go up? Because junk bonds went up. Junk bonds are really key to look at. And what happens when Bitcoin comes down? We anticipate that all the alts will follow suit. When they don't follow suit, they're called inverters, and we look for those. We typically can't find the damn things. They're very hard to find, but they do exist. When we see Bitcoin's gravity coming down, we expect the alts to come down. When we see Bitcoin's gravity going up like this, remember that escape clause, we expect that the alts will be doing the same. We want to look at strength. Remember I was talking about Solana and about rotation from Solana into ETH. Notice this particular high here, this high on ETH, and this secondary high on ETH, and this lower high on Solana. This points to capital rotation. This is what I'm talking about. One thing from a trading perspective, when you look at specific alts, they can overextend and underextend particular moves. For example, in the positive Bitcoin rally that we saw, ADA went nuts. And then when we had a retracement in Bitcoin, ADA went nuts again, but in the wrong direction. It's just something to keep in your mind. When we say no alt can escape Bitcoin's gravity, if Bitcoin is coming down, the alts are coming down. And this is literally a river of the top 100 alts. We can see Uni up the top and Phantom right down the bottom, and Bonk getting bonked as well. And we can see Pepe is just down 4.66%. And thank you very much for the comment in yesterday's video. Somebody said, it's not Pepe, it's Pepe. And Pepe is paying out for the shorts at the moment. But Pepe has such incredible volume in it. I really consider it is a good thing to look at, especially if you have a large account. It's also a pretty good idea to keep your eye on different ecosystems. And when we see the Ethereum ecosystem, we can see it's just following Bitcoin's gravitational pull. What about real-world assets, RWAs? RSR is doing quite well. What about in terms of gaming? Well, Bitcoin was the greatest gainer there, and Floki just leading up the back of the pack. What about the Solana ecosystem? Front is out in front, and Whiff and Bohm and Bonk and Jup, they're down the bottom. They're at the lower bank at the current time. Inside the service, Litecoin and Bitcoin, and followed by ADA, were the best performers. Solana and BNB were the worst. What about inside AI and big data? We can see a bit of a variation in here. IO is doing pretty well. Arkham, not too badly. What about the memes? You can see Bitcoin has recovered. That is a flight to safety. When you see specifically on the memes are a way to just gauge retail sentiment. Retail sentiment is quite negative at the current time. That means there's lots of bargains. And what about distributed computing and file storage? We can see Sys and Teo out the front, Bluezell leading the back of the pack. In wallets, we saw a short-lived spike that was quickly faded, so nothing much happening in there. DeFi, not too bad. Uni's out on the top bank. What about DPIN? IO doing pretty well. Arweave doing not too badly. What about Binance Labs? Oh, Alt is going for it, and BitGo is close behind. Centralized exchanges, nothing much happening there in terms of relativity to Bitcoin. The reason that we look at centralized exchanges and decentralized exchanges, when there's a flight to safety, often the DEXs and DeFi tend to come up, as well as the wallets. When there are meltdowns, the DEX and wallets tend to shine. So looking at different groups is not a bad idea. And when we look at the Bitcoin ecosystem, Bitcoin is leading the pack. Layer 2s, pretty much Bitcoin and ERN. The number of liquidations inside the market, nearly 45,000 positions, and there's been about 128 million in total liquidations, and the variance between the longs and the shorts is getting less. But we can see it's just not a lot of liquidations in comparison to what typically happens. In the past 24 hours, we saw a $45.8 million outflow in spot ETFs for Bitcoin. In yesterday's video on Bitcoin, we were just here, just as price was starting to turn around, and we were talking about where do you think it's going to go, to A, B, C, or D? Now, how did it play out? Well, it came up to B and then retraced kind of nearly midway between C and B. When we look at naked price like that, it's really unhelpful because we need to know where the structure is. What was actually occurring? We were coming up to a structural resistance around that 57,900 area. If we couldn't get above that, we were coming back to structural support around that 57,400. If we got above, we were heading to the next structural levels. But if we couldn't get above, we were coming back to stronger structural levels below the current price. Structural resistance and structural support are incredibly important to understand. It's important to understand where they are, how strong they are, how clustered they are. If we get a retracement back to the 58,500 and then get a bit of a movement and a consolidation above that 59,700, above the B point, we may be opening up higher values for Bitcoin. But if we start to underside retest the 58,500, that puts the C level into play. And if we don't confirm that as support, that puts the D level into play. Where do you think we're going in the next 24 hours? up to A, around B, around C, or around D? Please let me know in the comments. It's a really good way for you to think three-dimensionally. And if you have the indicator, you can have this structure so you can get a much better understanding as to where price can go. It's vitally important that when you're going long at spot, to not just take the up case, because you may not have bought at the bottom. You may find that there is further downside or price could just consolidate. Having these three dimensions to your decision making is incredibly important. When we looked at total crypto market cap in yesterday's video, it was just here. At the time of this recording, it's just there. Let's have a look structurally as to what the actual structure is inside the market. Remember, structure is just drawn up for the month, and it does change monthly because investors and traders change their perceptions on a monthly basis. But when we look across, we're looking towards the right. So you can just think about you were here and you're looking towards the right. Now let's have a look at that structure. It's also a really good idea to read total crypto market cap and Bitcoin simultaneously. We can see that there was a structural overhead resistance level at that 2.01 trillion. We just came up, tapped it, didn't get anywhere close to reconfirming it as support. That immediately opened up lower levels of structural support around that $1.99 trillion mark. And we managed to get over the 2.01, but it didn't confirm as support. It broke under. But gravity is a really important thing to just be aware of. You have to always keep in mind cut overs and cut unders and support levels and structure. There's a whole range of different things that you can do to look at price. We saw that we basically oscillated around the $2 trillion mark, coming down to tap lower structural support levels where the institutions were grabbing liquidity and pushing it up to higher structural levels. When you have these structural levels, it is an absolute game changer. You're not looking at a chart like this and saying to yourself, where could things go from? Where is the strong structure in play? Where does the gravity kick in? Remember, gravity is very, very powerful. And if we get a bit of a sell down, where could things get caught? Or if we get a push up, where could things just reverse from? That's why having the structural indicators on is really important. And look at all this low-hanging, strong structure from 1.953 upwards. That's pretty good. And we can see how structure reverses things. So it's very important to know where it is. I talk about these concepts inside the masterclass, and Joe D very kindly has offered a CTKS partial masterclass scholarship. Your name if you want to learn how to deal with financial markets from a professional level. Your name could be here. If you're interested, please reach out to me and directly message me on X, or you can email me at ctksmethod@gmail.com. And many thanks to Joe again. We know that Ethereum has been quite weak, and when we look at a naked chart like this, it's really hard to figure out where anything could be going. Because, for example, we just don't know where the structure is. We don't know where structural resistance levels are. We don't know where structural support levels are. And as a result, people just use recent indicative price, which RIPs their money. And they use a lot of indicators which are statistically based, but they're very biased. Biased towards the short term. This little I is where we were in yesterday's video or yesterday's price action. This I is where we are at the time of this recording. Now the key is to just pop on the structure and see what's actually happening under Ethereum's hood. Structure is an absolute game changer. When we pop it on, look at the difference. We have clarity. We know that we were trying to get above this 2670 mark of structural overhead resistance, but we just couldn't get through it. If we're not going above, we're going below. And look at this big sell-off as we had this cut under here. Look at this big sell-off. This was a negative fresh air gap, which meant we would likely overshoot. And where are we going to overshoot towards? The answer is stronger structural support, and we saw that 25-24 level get hit. We came back and retested that structural support, converted it into support for the short term, but there were just too many sellers. Now, what is actually occurring underneath this chart? It's Bitcoin and total crypto market cap. What you need to do when you're trading and investing in any particular alt, look at Bitcoin, look at total from the structural levels, and then look at your chart from its structural levels, and then cross-compare. It's not an easy thing to do, but if you're going to make money, making money is typically not easy. It does require skill. Take it from our great friend, Borsog the Eagle. Borsog is always looking at structural levels, looking forward and to the right. Borsog doesn't look left because it's boring. Borsog wants to know where price can get captured, where fresh air gaps are, because we need to buy at structural support, or else we can get on the wrong side of the trade, and that's pretty ugly. If you would like to get the structural levels on these 32 charts, all as TradingView indicators, you can just pop across to CTKSMethod.org and pick them up there. And whilst you're there, please subscribe to our newsletter, which is coming soon. It's completely free. Life can be pretty tough going. If you're going through a life pullback, please know that our love and healing thoughts are with you. And always just bear in mind that progress is twice the setback. If you're encountering delays and things are not going the way that you want, don't worry, they'll turn around and they'll be better than ever. As you've made it to this point, you're an incredible human being. You're just awesome. And you might like to just let me know that you've made it here by just putting a comment about awesome somewhere. And let's have a look at this. Yesterday, we anticipated that the shorts would get taken out of the market, that the market makers would come up and just liquidate those shorts. And that's actually what we saw. Now you can see a lot of longs have been buying the dip. For market makers, they would want to take this liquidity to add to more liquidity up here because there's a greater percentage of probability that a movement down is on the cards rather than a movement up. It's possible that they could move up, tap this liquidity and move down. But the greater liquidity is existing below the current price. They probably want to add people's confidence to the shorts, and when the shorts get liquidated, they are forced to buy, which actually raises the price up, as we've seen. I absolutely love the comments on junk bonds. We have such an amazing global family. Kate and I appreciate you all so very much and wish you a fantastic weekend ahead. Bye for now.